Expense recognition is a core principle of financial reporting that determines when costs are recorded in the income statement. Under accrual accounting, expenses are recognized in the period in which they contribute to generating revenue rather than when cash is paid. This matching principle improves the accuracy of profitability measurement by aligning revenues with the associated costs incurred to produce them. The program emphasizes that expense recognition directly affects reported earnings, asset values, and financial ratios. Companies must carefully determine whether expenditures should be capitalized as assets or expensed immediately. These decisions significantly influence financial statements, making expense recognition one of the most important areas for analysts evaluating profitability and earnings quality. One of the key distinctions in expense recognition is between capitalized costs and period expenses. Costs that are expected to provide future economic benefits are generally capitalized as assets and recognized gradually through depreciation or amortization. Examples include expenditures on property, equipment, and certain intangible assets. In contrast, costs that provide benefits only in the current period are expensed immediately. The CFA materials note that training costs and routine repair expenses are typically recognized immediately because they do not directly increase future economic benefits. Proper classification is essential because capitalization increases current assets and defers expense recognition, while immediate expensing reduces current earnings but avoids future amortization charges. The choice between capitalization and expensing has major effects on financial statements and performance analysis. According to the program, capitalizing costs spreads expenses over the useful life of the asset, resulting in smoother earnings patterns over time. Immediate expensing causes lower net income initially but may produce higher profits in later periods because no additional depreciation expense exists. Capitalization generally results in higher assets, equity, and profitability ratios during early years. However, as the asset depreciates, differences between the two methods gradually diminish. Analysts must therefore evaluate accounting choices carefully to compare companies consistently and determine whether reported earnings truly reflect operational performance or are influenced by accounting policy decisions. Expense recognition also affects the balance sheet and statement of cash flows. When costs are capitalized, the asset appears on the balance sheet and is reduced gradually through depreciation or amortization. Immediate expensing eliminates the asset entirely and reduces retained earnings through lower net income. The CFA materials demonstrate that capitalization initially produces higher total assets and equity because the asset remains recorded on the balance sheet. Although cash flows are unaffected in total, classification differences arise between operating and investing activities. Analysts should therefore distinguish between accounting impacts and actual cash generation when assessing company performance, liquidity, and financial flexibility over multiple reporting periods. Different industries often apply expense recognition differently due to variations in business models and accounting standards. Technology and pharmaceutical firms frequently face complex decisions regarding research and development expenditures. Under most accounting rules, research costs are expensed immediately because future economic benefits are uncertain, while certain development costs may be capitalized under IFRS when specific conditions are met. Similarly, companies must evaluate leases, advertising, software development, and maintenance costs carefully. Analysts reviewing financial statements should pay close attention to disclosures explaining management assumptions and accounting policies. Understanding these differences improves cross-company comparisons and helps identify firms using unusually aggressive or conservative expense recognition practices that may distort financial performance measures. Expense recognition plays a critical role in assessing earnings quality and identifying potential financial reporting risks. Aggressive capitalization policies can overstate assets and profits by delaying expense recognition into future periods. The program notes that inappropriate capitalization decisions may artificially increase net income and mislead investors regarding profitability. Analysts therefore monitor changes in depreciation rates, asset balances, and expense trends to evaluate reporting quality. High-quality financial reporting requires neutral accounting choices that faithfully represent economic reality rather than management incentives. A strong understanding of expense recognition principles enables analysts to interpret financial statements more accurately, compare firms consistently, and detect signs of earnings manipulation or unsustainable profitability.